Hi, my name is Jennifer Black. I will be your Kingdom Heirs stock market investment coach. If you are receiving this video, that means that you have signed up for one of my classes, and I can't wait to see you in class. The reason for this video is basically I want to give you an overview of how to research various different mutual funds before we get started in our class. There's a lot of terminology that will be used in class that if you are very much in the beginning of learning how to navigate in the stock market may not make sense to you unless you have viewed this video. And I don't want to take time, valuable class time, reviewing over all of these basic concepts. So that way you will have this video to keep, to go back and refer to if you have questions on things that I've covered. So let's get started. Okay, I am going to share my screen with you. Okay, here we go. So there are many different platforms available now to do your research, to use as your brokerage firm. I have chosen Fidelity, and Fidelity is the one that I will use for the purposes of my class. I'm going to give you a couple of reasons why I've chosen Fidelity. You're absolutely free to go with whomever you choose. The reason that I've chosen Fidelity, Fidelity and Vanguard are two of the top brokerage firms out there. The reason that I've chosen Fidelity, though, for purposes of this class, and that's where I actually keep my portfolios in as well, is because Fidelity has a lot of mutual funds that outperform Vanguard in my opinion, and I'm going to show you that a little more towards the end. But they also have no investment minimums for many of their mutual funds, whereas a lot of Vanguard funds, you have to have a minimum of $2,500, $3,000, you know, so on and so forth. And if you're a beginning investor, you know, you're just getting started, you may not have that kind of money to put in. You know, maybe you only have $20 a paycheck that you can afford to get your portfolio started, which is fine, which is great. At least you're getting started. And that's why Fidelity is my choice for that. That's the primary reason for most people. So I am going to give you kind of a walkthrough of Fidelity's site, so that you know if you do choose to go with Fidelity. Again, like I said, you absolutely do not have to. That is completely personal choice. But if you do choose to go with Fidelity, then you can kind of have a little bit of a head start on knowing how to navigate their site when you want to research different funds. Okay, so you are going to go to news, and you actually can research funds on this page without having an account. Which makes it kind of nice, because you can, even if you do choose to go with another platform, but say you like their platform for research, you can still research like their mutual funds and various different things. Okay, so under news and research, we're going to go to mutual funds. Okay, so before I show you the types of mutual funds that I like to look at in this screen, I'm going to give you a kind of a snapshot of why I go this route, why I go with Fidelity. So I'm going to leave this selected, no transaction fee only. The majority of the funds now don't, well, I'm not going to say a majority, but at least for Fidelity, they have no transaction fees. With your buying, your selling, there's no load fees. The only fees that they have are the expense ratios, which is basically the cost of the management fees. And those fees are pretty minimal. They're very competitive in the market, Fidelity's. So we're going to select this first so that we can look at all mutual funds, not just Fidelity's, and then you can kind of see the difference. Okay. So when it first comes up, it's going to give you, well, first it's going to show you there's 3,482 no transaction fee mutual funds. So what I'm going to do these top ones are just a couple of Fidelity ones that they give you, that they kind of just, you know, they want to show you what they have to offer, a couple of options. What I like to do when I'm first beginning to select which mutual funds I want to look at is I sort by the column that says 10-year. The majority of the portfolios, I'm looking at a long-term perspective. I want to know, how is this fund doing long-term? There are some times when you're looking at a short-term, certain types of savings goals, but for the majority of what we cover, it's going to be some more long-term goals. And for the short-term ones, I'll kind of show you, you know, the difference and how we're going to do that as well. So we're sorting by the 10-year. We want the top funds with the 10-year average. There's also a column right here that shows you the life of the fund. And what that means is that is the yearly average for however long that fund has been in existence. If it's been in existence for 25 years, the yearly average, once you take, you know, the returns on every single year, you average them together. For example, this one is a 12% average. But we're looking at the 10-year column. This one is 23%, the 5-year is 28%, the 3-year is 42%, and so on and so forth. These are awesome returns, there's no denying that. Okay, so we're gonna open this one up and we're gonna see what, this is the Morgan Stanley fund. So we are gonna open this one and see what we're looking at. So this particular fund has an overall 5-star rating from Morningstar, which is a, basically it's a company that reviews all the different, you know, mutual funds and investments to kind of give you their review, their take on the overall returns of that fund, the expenses, the risk levels, the fees involved. So they've given this one a 5-star rating. When we come down here, first thing that I notice is this one has a load fee. And I'm going to click on this because it will give you a definition of what that means. And it tells you that the load is a sales charge added to the price of the fund that must be paid at the time of purchase. Mutual funds that don't have any sales charges are called no load funds. Not all funds charge a load. Check a mutual fund's prospectus for more details. Okay, so that means to even get into this fund, I've got to pay 5.25%. Now, next we have the minimum to invest. It's $2,500 to even get into this stock, or I'm sorry, this mutual fund. So for me, if I'm a beginning investor, that's an immediate, you know, turn off for me because I want to be able to put just a little bit at a time to grow it. And then not only that, it has the 5.25% load fee. There are so many good options out there for mutual funds now that are getting great returns that 5.25% is a deal breaker for me. Okay. So let me come back and let's check out the next one. The next one is the Morgan Stanley, or wait a minute, I apologize, I skipped, is the Berkshire Focus Fund. Okay. Another note is in this column right here, it tells you the category of this mutual fund. This one is large growth, which means that this is this is a growth fund. It's probably not going to return much for dividends. Its sole focus is having large companies, and it's a growth fund where you're constantly reinvesting that money back into the fund versus paying out, you know, hefty dividends. This one is a technology fund. Okay. So this one, when we check out this one, the returns, okay, let's check out the returns first. 22%, 25, 35, 50. I mean, those are great returns again. But now you're looking at, this one has a high expense ratio. It's 1.95%. It's got the redemption fee of 2%. And then you've got the minimum to invest, $5,000. That doesn't work very well for somebody that's just getting started. So again, this one would be a no for me. I just wanted to show you a couple of those examples before I come back. And now we are going to, we're going to select the Fidelity mutual funds. And again, you know, at any point, if you want to continue to go down through those and look at them, there may be some other funds that don't have a minimum to invest and they still have good returns. Personally, I don't feel the need to, at this point in time, go with any other funds other than Fidelity's because they have everything that I need at a one-stop shop. Oh, I apologize. I should have showed you what I was doing. I was just selecting the option that says Fidelity mutual funds only. Okay, so now we're just looking at Fidelity's. And I'm going to do the same thing. I'm going to select the 10-year because I want to sort them all. Okay. So this top fund here is a technology fund. Now, what I'm looking for when I'm looking at these, it may have a great 10-year average, but if the 5, 3, 1-year averages are not good, then that's a fund that I'm not really interested in because I want consistent, steady returns no matter what the time frame is, whether I've had it for a year or whether I want to hold it for 3 years or if I want to hold it for, you know, until retirement. So I'm looking at pretty consistent high numbers in here. So as you can see from here, you know, we've got 22%, 23, 25, 33. You come down to the next one, same thing. You know, for the first several funds, you're seeing, you know, high returns. An example of one that I'm not saying that I would completely discount it, but I'm less likely to go for would be, for example, this fund right here. See how it's 19% and then the 5-year average is 2.75%. That tells me that they had a few rough years. Now, I possibly could still be interested if I'm looking at this fund as a long-term hold because during that time when it was down, that would have been a good buying opportunity for me to buy as many shares as I could. But again, for my purposes, what I prefer to do is stick with the ones that are pretty steady. Okay. Again, you have your Morningstar category where, you know, you've got technology, consumer cyclical, technology, you know, health, large growth. You do want to try to vary these up. You want to have diversity in your portfolio. A lot of people really like to push the total market funds or the S&P 500 index funds, which are basically a ton of different stocks with individual stocks within the fund. And that basically mitigates your risk a little bit by having more funds because as some go down, you know, and some are going up, you know. I personally am not crazy about that method, even though that's what a lot of people prefer. But again, we'll get into that later and I can show you some comparisons. I prefer to do sector funds, which means that it's specifically in one sector and then I diversify by having multiple sectors within my portfolio. And just in case, I'm not sure if I mentioned it or not, for those that may not understand what the concept of a mutual fund is, I apologize, I should have said that in the beginning. But basically, a mutual fund is a fund that is actively managed by a manager at whatever brokerage house it is. For this purpose, we're talking about Fidelity Funds. So they have fund managers that manage all of these different funds. And what they are is within each fund, it has a collection of stocks within that fund. So they're constantly buying and selling within that fund to get you the best return. So for a lot of people that are just getting started, I really recommend mutual funds as the best way to start. I will be doing a class probably, I'm going to say within the next 1 to 2 months, I'm going to add another class that will cover market research for if you want to buy individual stocks. Individual stocks can have greater performance than the mutual funds. However, there's also more risk involved with those as well. Basically, how it works in the stock market is the greater the risk, the better the returns. But also the greater the risk, the more volatility. Like you could lose money very fast as well. So when you're just getting started, I really like to recommend getting started with mutual funds, because you have a manager that's actively managing that fund. And when it has a long history of great returns, you could feel pretty comfortable within that fund. But again, everything that we cover basically boils down to your comfort level. And that's what we're going to go into more depth in within the classes, as far as for your different savings goals, different ways to approach investing based upon your goals, but also based upon your comfort level. Because let's face it, even if you are getting great returns, but there's a high volatility on the funds you choose and you can't sleep at night, that's not really doing anybody any good, because you're worried about losing what you've got in the market. So okay, so let's move on. What I'm going to do is I am going to use basically just this top one so that I can kind of cover all of the different things that are shown within the platform to show you basically how to study this particular mutual fund, how to look at it, and all the information that comes with it. So like I've said, on this page, you're going to see the category that it falls under. You're going to see all the different time frames on the returns, your 1 year, 3 year, 5 year, 10 year, the life of the fund. This is your expense ratio right here. This is what they charge to manage this fund. You never actually see this amount coming out of your account. It's actually figured into the share price. But Fidelity has very reasonable expense ratios. Another thing I'd like to note is that the returns for the 1 year, 3 year, 5 year, and 10 year are all of these averages are figured at the end of each month. So that's why it says up here that the Fidelity Fund performance data as of 7/31. Okay, the year-to-date number is it's a daily, they daily calculate this, so you kind of know each day how it's doing as well. Okay, so let's check out this fund, and this is a fund that I own in my portfolio. Okay. So this first page is basically like a summary, this tab right here, where it gives you a lot of information on one page, okay? So this one, as the Morningstar rating, is an overall rating of 5. The returns are between average and high. This is according to Morningstar's research opinion, whatever you want to call it. So the expenses are considered below average, which I find that the Fidelity mutual funds are below average, for at least for the level of returns you're getting. I really think that they're very fair in their expenses. Okay, the risk of this category is a little bit on your higher end, where and it shows if you put your mouse over it, it'll tell you it's a 7, basically a 7 out of 10. 10 is the highest and 1 being the lowest. Here is your returns that I just showed you on the previous page. Okay, so once we move down here, this fund inception, this fund basically began in 1985. Okay, so when I'm looking at the returns on a fund and I'm looking at this 10, 5, 3, 1 year returns, if they only have 10 years in existence, not to say that that could, you know what I mean, that it may do very well. But personally, I like to see the funds that have a longer history, like this one, 1985, because I know that this fund has been through some market crashes, so to speak. It's been through, the 2008 crash. It's been through the dot-com bubble in 2000, 2001, 2002, I believe were the years. So I've been able to see how it's performed and how it's recovered from those. So I like that long history. You've got your expense ratios, you've got your current price, the last current price for this mutual fund, you've got your portfolio net assets. Now, these are in millions. So what this means is that this particular fund is managing $10,462,000,000. That's a lot of money. Vanguard and Fidelity are the top two mutual fund holders for, you know, all of the brokerages. I believe Fidelity, last time I had looked, I believe it says that Fidelity is in the trillions is what they manage overall in their overall portfolio with all their funds. Okay, this tells you the 12-month low and high, which is the $15.80 was the low, $23.80 was the high of the last 12 months for this fund. This little chart right here is kind of an interesting chart. It tells you the hypothetical growth of $10,000. So if I had put $10,000 in back in 2010, as of right now, the purple line is this particular fund, I would have $73,563. And what this shows is the benchmarks, the different benchmarks that it's compared to. This is the S&P 500. This is where, you know, a lot of times people will recommend that you invest in a index fund for the S&P 500, which basically means that it's got all of the companies in the S&P 500 within that fund. So that way, as you know, as they go up and down, it's a safer investment, but your returns are not going to be nearly as good. And I feel that there's different ways that you can mitigate that risk without giving up, a really large portion of your returns. So what this is saying is for the S&P 500, if you had put 10,000 in back in 2010, because they are the, they are the blue line. So the blue line, you would have 36,000, okay? If you had put it in this particular, I'm going to show you what this is. This is an index that it has similar, well, you can read the exact description of it, but basically it's an index of stocks that measure the performance of software and services companies, basically similar companies to what's in this fund. And for that one, let's see, they are the orange one. So that one would have, if you put 10,000 in, you would have 65,000 now. Okay, the technology sector as a whole is the red line. That one you would have 49,000 if you had put it in. So as you can see, this particular fund is considerably higher. The closest one that compares is the what was it? Was the index right here, this MSCI index. It's kind of a neat little, chart to play around with it and see how it works and how the particular fund that you're looking at performs compared to other benchmarks. Okay, this right here shows you the top 10 holdings of this particular fund that you're looking at. And just a quick little note, if you are looking at buying individual funds, this is a place that I like to start just to do some research. I like to look at, okay, well, this particular fund is doing very well, so let me look at the types of stocks that they're holding within this fund. Some of them are very well known. Some of them, I don't know quite as well. Like I'm not as familiar with Autodesk Inc. But 62% of their portfolio is made up of these stocks. So like I said, that's a good starting place if you want to research individual stocks. Because even if you buy individual stocks, you still want to have that diversity. You don't want to have it all in, any one sector. Now, I will say that with my portfolio, depending, I have different portfolios for different savings goals. I do tend to be a little bit more tech heavy, tech and healthcare. But again, that is a complete preference, of yours, depending on your comfort level with risk. Okay, so it also gives you some similar fund picks. So these are some similar mutual funds to this particular one. Okay. Over here, it tells you the fund manager information. How long has this fund manager been managing this fund? You know, this one's been 6 years. Some people like to, if they see that there's a new fund manager, they're a little bit more weary of going with that particular fund because, you know, they're new with that fund. Doesn't mean that they're a new fund manager, but maybe specifically with that particular fund, they're new. So for some people, that's, you know, a concern for theirs. Down here, it gives you the strategy of what they're looking to invest in, how much they're looking to invest in different stocks. It gives you some risk information down here. Here are the quarter end average returns that the same ones as we've looked at above, but all of these benchmarks that we talked about up here on this chart are listed down here, so that you can see how did it compare to these different benchmarks. So the 1 year, this particular fund returned 30%. The S&P 500 returned 7%. And this is an example of what I like to talk about, where a lot of people are very much, you know, you have to go with an S&P 500 index fund. You have to do that. It's the safest bet. But look at how much you're missing out on returns. Now, granted, your whole portfolio shouldn't be in this particular fund, but there are other funds with different sectors that have similar, you know, returns. Again, a lot of it depends on your comfort level. So this particular index was at 24%. Technology sector as a whole was at 25%. And you can compare these with each time frame. Okay. Next, we're going to move over to performance and risk. Again, we're getting the same benchmarks that we looked at on the previous page, so I'm not gonna, you know, go over that again. The same chart that's on the summary page. This part right here is really interesting to look at because it tells you the returns for each benchmark, not just the 1 year, 3 year, 5 year, 10 years. It gives you each individual year. So you can see, you know, it went from 18%, 2%, 18, 51, which is awesome. You know, 8, 10, 10, 38, another great year, you know, so on and so forth. One thing I wanted to show you with this is where I like to do a little more research. This only gives you basically the 10-year returns on the website. However, Yahoo Finance, they have some great research tools on here as well. So I just type in the fund name, and when I want to look at performance, they give all the same type of information that you're going to get on the Fidelity site, but they give you the annual total return history since the fund was created. So I can look all the way down to 1985, and I can see all the returns for each individual year. Now, as you can see, this was the dot-com bubble right here, where obviously the returns were not great by any means. 2008 crash happened right here. But one thing I'd like to note on this is look at the returns that you're getting on this leading into this. The year before the dot-com bubble, it had a gain of 93%. So yes, it did lose, you know, but it still didn't even come close to losing what the previous year's gain was. And then immediately the year after, it rebounded, it went up 35%. So that's one of the things I like to look at. I like to see how is this fund performing during those times. You come up to 2008, the year before 2008, look at the 2 years before, we're looking at, what's that, 47%. Now, granted, it did lose 42% here, but then it rebounded and went up 61% the year following. So I like to see the numbers of how it's performing right before and right after those, you know, when we have a crash like that. Okay. Let's see, let's come back to this screen. This is, again, just more benchmark information, the average returns. Nothing new there. Okay. Ratings. This is, again, this is pretty much your Morningstar ratings. It tells you overall they have a 5-star rating out of 197 funds. When it puts these funds in here, it basically gives you like, when it says out of 197 funds, they're comparing similar funds to this with the different, brokerage firms. Out of the 3-year average, they gave it a 4-star. 5-year, 4-star, and 10-year returns, they gave it a 10-star. The Lipper ranking, this is another, basically a rating, a company that rates the different funds, and it's giving you the, so the 1 year is ranked number 84 out of 179 funds, 5 years is 29 out of 146 funds, 10 years, it's the number 1 out of 123 funds. Now, again, so you may find for a short term, if you're looking for something really short term, you may find better funds out there as far as the returns. However, you may also be looking at having to put more to get into the fund, just like I showed you in the beginning. You may have load charges. So those are things you want to take into consideration, even if there's a fund that may have better ranking, like with these different rating companies. To get that greater return, you're giving something else up in most cases. Okay, let's see, composition. So this page basically tells you the industry, the sub-industries. Now we know this is a technology fund, but we're looking at the sub-industries within technology. They're heavy in system software, application software, data processing, and outsourced services, so on and so forth. These are their top 10 holdings, which we did see on the previous chart. Their asset allocation. So this is basically showing you where their assets are invested. This is mostly in domestic equities. Equities is another term for saying stocks. So basically they're in mostly in domestic stocks. They have, a small portion in the international stocks, developed markets, emerging markets, which are like new companies, like emerging would be like new companies. They have no money in bonds, and then they keep 3.59% in cash. And this is to take advantage of, when there's a dip in a stock and they want to buy in at that time. It's a great stock, but it's dipped. They want to have cash on hand so that they can turn around and buy into that stock. And then they also have to have cash on hand for, when somebody, pulls money out of their account. If somebody pulled out a large sum of money, they need to have cash on hand, so that way they're not forced to sell securities or stocks during a time where it may not be the most advantageous time to sell those stocks. Okay, so now we break it down to regional diversification. So again, just like it said up here, domestic, which means that they're mostly invested in the United States. So 93% in the US, they've got a little bit in Europe, the emerging markets, a little bit in Canada, Asia, and then here's their cash amount. Again, breaking it down by country diversification, the currency diversification. Let's see, fund facts, their fund inception, the amount of assets that they hold. Okay. Let's move over to fees and distributions. Okay, this is basically the, what we talked about before, the expense ratio for this particular fund. And so just a note here, one of the reasons that a lot of people like index funds is because of the expense ratios are lower. You may get like a 0.03% or 0.1%, which is obviously lower than this expense ratio. However, the way that I look at it is, if my overall returns, let's just say for an example, a 10-year return, I'm getting 20% on a 10-year return average for this particular fund, okay? And maybe on one of these index funds that, have the lower expense ratio, I may only be getting 10 or 12. I'm willing to pay that, 0.75% or so more on the expense ratio for this actively managed fund when I am getting 8, 9, 10, 11, percent higher return. To me, that's worth it. But some people don't see it that way. Okay, so here's the dividend history. This particular fund is a growth fund. It does not pay out a lot in dividends. They're basically trying to just keep pushing that money back in, reinvesting the money, buying more shares of stocks, so that way they can continue that growth. So here is where, they pay dividends in April and in December each year. Capital gains history. There is capital gains that are paid on mutual funds, and basically the point of what capital gains are is when a fund has made a certain amount of money, especially if they had a really good year, they have to pay out a certain amount of that back out to the shareholders in the form of capital gains. They lower the share price by that same amount to keep people from trying to hurry up and sell right before the end of the year and take advantage of, say, if they had a loss, for example. So they lower so it really doesn't have much of an effect on the value of the mutual fund, but it is something that they do because they're only allowed to keep a certain amount of those gains that are being made from the buying and selling of the share, the stocks within the fund. So they have to pay out a certain portion as capital gains. Okay. This section right here, if you were looking at another fund, like for example, some of the ones I showed you in the beginning, would look very different. The initial investment, 0, which is great. Like I said, you can put $5, $10 in if that's all you can afford. If it were a different one, it would tell you the additional investment. Some of them, they may have a $3,000 initial investment, and then you have to put at least $100, or some of them $500 anytime you make a subsequent investment. Which again, this is great for with Fidelity because you don't have to have that amount. Let's just say you can only afford $20 a paycheck, $10 a paycheck, whatever you can afford. You can put that money in, and you can still take advantage of those returns and watch it build up. So you have the sometimes if you're investing in an IRA versus a taxable account, they have different requirements. So that's where it would show all of that in here, if that was the case for Fidelity. And then you've got your price history by month, your lows and your highs, the close at the end of each month. This little part right here shows you the type of accounts that you can hold this particular fund in, which you can put it in retirement accounts. Pretty much any account you can hold this fund in except for check writing accounts, which are typically certain types of 401k accounts where you can invest in anything. You can invest in real estate, you can invest in numerous different things. So they do limit it to you can't put it in a check writing account. Okay. Let's see, commentary. It's basically a chance where the fund manager can tell you, their main summary or their main notes of what their intentions are with the fund, what's happening with it. And then there's a Q&A section. If people have, questions, they'll answer them here. This is, again, the view all tabs is basically a summary of everything that we've covered, and they just put it into another tab here. Okay. So let me go back to let's see if I can get back to that first screen here. Okay, well, to make this quicker, I'm just going to go back to mutual funds. Okay. I'm going to sort by my 10-year. So one thing that I'm looking for when I take individual funds is I'm going to select a couple of them that I actually own in my portfolio. I'm not going to go down all the way because I own, several different ones, but I want to take a couple of, okay, so there's a health. Well, here's one right here, consumer cyclical. I'm just going to compare these funds. Okay. This brings up, another screen with a lot, it's pretty much all the same information, but what I am looking for, there we go, that's the screen. So I'm looking at these 4 funds right here. At the beginning of the year, I'm typically kind of evenly distributing money between the funds. But as we start to get a little bit further in the year and you start seeing, it may even be only a month in or, whatever, you're going to see them start kind of, their year-to-date numbers. You're going to see them start pulling away from each other. Some are higher, some are lower, whatever. Because I know that these funds all have similar, they all have great returns in their 1 to 10 year averages. What I'm looking for is, for example, right now, I'm putting a little more money, and you can, do it however you want to do it. I, for example, am putting more money into this fund right now because the year-to-date number is down. I am putting more money in it while it's dipping. Now, I know these are the averages that we have for this fund, so I know that so for it to be at 10% right now, it's down a little bit from what the yearly averages are. So I'm going to be putting more money into this right now because this is the, the lowest fund right now. This is where I'm buying it, basically what you would call buying it at a discount from what the yearly averages are. They're all doing fairly well. Maybe on this healthcare one, I may put, a little more into this because again, it's down a little bit, not really very much compared to this one. And I am going to go back to Yahoo Finance because I want to show you if we are in a case, for example, when the market's crashing and every paycheck, I'm putting money in, I'm investing, I have my certain amount, that I put in. If we're in the middle of it crashing, I'm buying as much as I can during these times right here. A lot of people get afraid and they don't want to, but the people that really make money in the market, this is when they are buying. Now, if you're using money that you need right now, then no, you absolutely should not be doing that. This is money that, like it's for retirement or long-term goals that are, a few years out at least. This is the best time to be buying because look at, let's see, was it this one? Just for an example, 2008, I mean, you could use any example, but 2008, as this is going down and it's, dropping fast and I'm buying, obviously you're never going to hit the exact bottom. And some people try to time the market and hit the exact bottom and it usually doesn't work out very well for them. So I'm just doing what we call dollar cost averaging is every time, when I get paid and I put my money in, I'm buying at that time as it's on its way down. So, when I buy at say 42%, or if I'm buying when it's 40% down or 35 or whatever, when this turns around the next year and goes up 61%, I'm making a great return on that. Had I not been buying during this time, then my returns, I mean, I would have recovered what I had, but I sure as heck wouldn't be, further ahead than where I was at beforehand. So like I said, that is the best time right down here to buy. Now, when you're in a case like right now where the market, I mean, yes, we did have the beginning of the whole COVID thing where it was dropping. And again, I was buying during that time. As it's come back up, when you do the average on the returns, that has made my returns pretty darn good because I continued to buy during those times. So that's why right now, even though none of these funds are down, it's still, they're all doing well. I'm still wanting to buy the ones that are at the lowest. Because I do know that they have a history of great returns no matter what. Let's look at this one, for example, FSELX. This one does tend to be a little bit more volatile, but as long as you're buying it in the dips, then you'll do very well with it. Let's let's see, that one is FSELX. Okay, so this one, you see some more down times right here. Again, I'm buying it when it's in the dips. And if you look at the history, there's some years that are just awesome returns. I mean, you've got 35%, 27, 32, 68, 41, 51. Those years when it's soaring, you know what I mean, when it's just doing incredible, I'm not buying as much during that time because I was putting the majority of my money in during the dips or when it was down for the year. So if you look, the year before that this one went down, it was up 51%. So look at this, 157% in the 2 years prior to that. So yes, even though you dropped here, you know, you still came out ahead, and then it came back 71% the year after. Same thing during 2008, but then it came back 84%. 2011, it was down 8%, but then look, 39, 38, 32, 35. So this one is, as you can see, this one is a more volatile stock. But as long as you're buying when it's going down, you'll do great. And then that's also, like I said, what we're going to cover in the classes. There are certain times when you're not going to want, you're not going to want to buy during these. Well, I'm not going to say not want to buy, but you're not going to want to have as much in a fund like this, depending on where you're at in your stage of life, what you're saving for. As you get closer to that goal, you want to start pulling out of these types of funds. And like I said, that's stuff that we're going to cover in class. So I think that is about, oh, wait a minute. I've got one more thing I want to cover. Now that you've seen everything that we've been talking about with Fidelity, I want to give you an example of, so you can see the kinds of returns on some of the funds that I see in different groups that I'm in, where, you know, people talk a lot about, you know, the, you know, personal finance and investing, and everybody kind of shares their ideas and, you know, so on and so forth. So a lot of people are big supporters of, like I said, Vanguard. And so this is a fund that I hear a lot of people, there's a lot of, you know, talk about. People love this fund. Let's see, this fund just, I think, yeah, they just started it in 2010, and it has had some great returns. But if you look at the averages, 7%, 10%, 10%. Now, if you remember when we looked at a lot of the Fidelity ones, we were looking at, you know, upper teens or low 20% for these, or higher for these, you know, time frames. And so even though the expense ratio is just slightly more than you would get in something like this, in this, this one is an actual ETF. I still think it's worth it to go with the Fidelity funds. This one is, it is an S&P 500 ETF, which means that it has all the companies within the S&P 500. So it kind of mitigates some of that risk. But as long as you're strategically buying in the dips, you'll be fine with the other funds. Let's pull up another example. This one, another one that people like to talk about is the total stock market index, which is basically a collection of pretty much all the funds or all of these stocks within the stock market. And again, to give it it mitigates your risk. But again, let's look at the returns. 6%, 9%, 9%, 13%. That's because in this, you have a lot of really big winners, but you also have a lot of really big losers. And when you average them all out together, yes, you're still coming out ahead, but I'm not willing to give up the gains that I'm going to get with Fidelity's funds. Just one more example with this, so then just so you can really get a clear picture when you hear different people talk about these different things. This is a Vanguard 500 index fund. Now this one's a little bit better than some of the other ones, but again, you're looking at 7%, 10%, 10%, 13% when you compare them to Fidelities. And now remember, when I was showing you Fidelities, we're talking there were funds that had awesome returns in many different sectors. You know, we're talking about consumer cyclical. We are talking about healthcare funds. We're talking about technology. So if you're buying in those various different sector funds and they all have those same type of returns, you're still going to come out ahead better than if you were right here. Now, the only time that I would say that you want to go more for the total stock, you know, the 500 index funds or the total stock market funds is if you are entering into retirement or you're in retirement. Then it becomes a little bit of a different story. But when you're in those growth phases, you know, leading up, you know, and you've still got, you know, at least several years out, you want to go with these type of funds. So I think that is all that I wanted to cover in this video. Hopefully it was very informative and you learned a lot on how to research these and a couple of different tips along the way. And I will see you all in class, and I hope to make it an interactive experience in class. That's why I wanted to get all of this portion out of the way first, so I'm not basically just talking at you the entire time in class. So you have this background coming into class, and it leaves more room for interaction, you know, discussion. So again, I will see you all in class. I'm excited to meet all of you. Thank you.